right now, the United States housing market is, it's practically frozen.
Oh, completely iced over. Yeah.
Right. So we are looking at this environment where nobody is selling their house and, nobody's moving into new houses either.
Exactly. The natural engine of residential turnover has just ground to an absolute halt.
And yet, somehow, the biggest home improvement retailer in the country just reported an increase in their earnings per share.
It's wild. It really defies logic at first glance.
It does. So, okay, let's unpack this. How exactly do you make money selling house paint and 2x4s when nobody is actually buying houses?
Well, you have to completely rewrite the traditional retail playbook. You really do.
Right, and that's what we're looking at today with Lowe Companies, Inc., trading under the ticker symbol LOW.
Yeah, their Q1 2026 earnings call is honestly a masterclass in navigating this mess.
A mess that their own CEO, Marvin Ellison, called the most difficult housing market since the financial crisis.
Which is saying something. When you hear a chief executive invoke the ghost of 2008, you naturally brace for a bloodbath on the balance sheet.
Oh, totally. You expect the worst. But instead, we're looking at a company that is actively capturing market share in, basically a stagnant pond.
They're absolutely stealing a bigger piece of a shrinking pie.
And that paradox is exactly what we are decoding today under our Talk Tickers banner. Welcome to the deep dive.
Glad to be here. This is going to be a fun one.
Our mission here is to cut through all that corporate jargon, strip away the executive pleasantries and give you, the retail investor, a data-forward, actionable breakdown.
Right. In plain English. No fluff.
Exactly. We're going straight to the raw data to see what Wall Street is actually reacting to. So let's look at the headline numbers.
Let's do it. Hit me with the top line.
For the first quarter of fiscal 2026, Lowe's delivered total sales of $23.1 billion.
Which is just a staggering amount of volume. Moving $23.1 billion in merchandise through the registers in a single 3-month period under these macroeconomic conditions is a monumental logistical achievement.
It really is. And that top line revenue figure, that represents an increase of 10.3% from the first quarter of last year.
Wow. Double-digit growth right now. That's huge.
Right. But more importantly, it aligns perfectly with their internal projections.
So they saw this coming.
Yeah, they aren't just surviving the environment, they're predicting it accurately.
Which Wall Street loves. Predictability is everything.
Exactly. But then we drop down to the bottom line, which is, the profitability metric that dictates actual investor value.
Earnings per share, or EPS.
Bingo. Their adjusted diluted EPS came in at $3.03.
Okay, so breaking that down for everyone listening, what does that actually mean?
To put that into plain English, they managed to grow their earnings by 3.8% versus the prior year.
That's incredible. They are squeezing out profit growth in an ecosystem that is fundamentally hostile to their historical business model.
It makes no sense until you dig deeper. So what's driving that?
Well, what's fascinating here is how the margin story is playing out beneath those headline revenue figures. The whole architecture of their profitability is shifting.
Shifting how? Are they making more per item?
Not exactly. If we look at their gross margin for the first quarter, it actually landed at 32.7%.
Okay, and how does that compare to last year?
That is a dip of 70 basis points, or 0.7% from the prior year.
Ouch. A 7% drop in gross margin across $23 billion in sales is a lot of money.
It is. And, a retail investor might look at that shrinking gross margin and immediately hit the panic button.
Yeah, assuming Lowe's is losing its pricing power or getting crushed by supplier inflation.
Right. But let's stop and look at the mechanics of that 70 basis point drop, because it isn't about Lowe's forgetting how to price a refrigerator.
Oh, so there's an external factor here.
Exactly. The gross margin is dipping primarily due to the dilutive impact of their recent acquisitions.
Ah, right. The big buyouts, FBM and ADG.
Yeah, specifically FBM, which is Foundation Building Materials, and ADG, the Appliance Delivery Group.
So when a company buys another massive entity like that, how does that mathematically drag down the gross margin in the short term? Why does buying a company make your profit margins look worse?
Because the penalty of acquisition is steep and it's immediate. When Lowe's acquired FBM, they weren't just buying a name.
What were they buying?
They were buying an entirely new supply chain network dedicated to drywall, metal framing, and suspended ceiling systems.
Which is heavy, bulky, and expensive to integrate.
Exactly. They absorbed massive integration costs. You have overlapping software systems that need to be merged.
Right. IT headaches.
Total IT headaches.
Yeah.
Plus duplicate administrative overhead and the literal cost of, repainting and rebranding fleets of flatbed trucks.
Wow. Yeah, you don't think about the cost of painting 1,000 trucks.
It adds up fast.
Yeah.
But more importantly, they are dealing with the amortization of intangible assets.
Right, the accounting stuff. Let's keep that in plain English for the folks listening.
Sure. Basically, the earnings call noted a $96 million pre-tax non-GAAP charge just for acquisition-related amortization this quarter alone.
That is a huge chunk of change to write down in one quarter.
It is. So they're taking a calculated short-term mathematical hit on the gross margin to build a long-term strategic moat.
Okay, that makes sense.
Yeah.
But the metric that measures their actual operational discipline, like how well they're running the day-to-day stores, that's the adjusted operating margin rate, right?
Yeah. And that came in at 11.5%.
11.5%. Is that good?
That 11.5% is the number that proves the core machine is highly disciplined. It was down slightly, about 43 basis points, but management telegraphed this well in advance.
So no surprises there. How are they shielding that operating margin then?
Through something they call perpetual productivity improvement, or PPI.
PPI. Sounds like corporate buzzword bingo. What is it actually?
It's basically their internal efficiency engine. Instead of passing every single inflationary cost down to the consumer.
Which would obviously destroy foot traffic, yeah.
Right, exactly. So instead of doing that, they are leaning heavily into internal efficiencies.
Yeah.
They're automating distribution centers, for example.
Getting robots to move the heavy pallets?
Yeah, robots and advanced routing software. They're also optimizing labor scheduling and using data analytics to reduce inventory shrink.
Shrink meaning theft and damaged goods.
Exactly. Just tightening the belt everywhere that doesn't impact the customer experience.
Okay, I hear the argument for internal efficiency, but I have to push back hard on this next metric.
Lay it on me.
Comparable store sales. So the revenue from stores open for at least a year were up just 0.6%.
Yep, 0.6%.
I mean, you look at 0.6% and that sounds like statistical noise. It sounds like a rounding error.
Definitely sounds tiny.
Right. If I'm holding this stock, I want to see meaningful growth. Is a 0.6% increase really a victory? Or is Lowe's essentially a giant shark that has stopped swimming forward and is just trying not to sink?
Well, look, in a normalized economy where housing turnover is healthy and interest rates are sitting at like 4%, a 0.6% comp would absolutely trigger a massive sell-off. Analysts would be demanding a turnaround plan immediately.
But this isn't a normal economy.
Not at all.
Yeah.
We have to evaluate the performance relative to the gravity of the current macroeconomic environment. Right now, flat is the new up.
Flat is the new up. I like that.
It's true. Squeaking out a 0.6% gain means they are not just treading water, they are actively stealing market share.
Stealing from who?
From independent hardware stores, specialty distributors, and obviously their primary big box competitor.
The orange giant across the street.
Exactly.
Yeah.
So the pie itself isn't getting any bigger, but Lowe's is taking a slightly larger slice of it.
Okay, that makes sense. But that forces us to look at the demographics of the transaction. If the pie is stagnant, who is actually swiping their credit card at the register?
This is where it gets really interesting. It's a tale of two entirely different consumers.
Break that down for us. Who's buying?
Well, let's start with who isn't buying. The traditional do-it-yourself customer, the everyday homeowner, who historically served as the bedrock of Lowe's revenue.
Right, the weekend warrior.
Yeah, the weekend warrior. They are pulling back aggressively. Comparable transactions for the quarter actually declined by 0.9%.
So the foot traffic is simply lower.
Much lower. People are deferring discretionary projects. They aren't coming in on a Saturday to buy like a new $300 vanity for the guest bathroom.
Or upgrading their patio furniture just because spring arrived.
Exactly. The nice-to-have projects are being put on indefinite hold.
And yet, despite fewer people walking through those automatic doors, the comparable average ticket size, the amount spent per transaction, increased by 1.5%. Yeah. So you have fewer shoppers, but the ones who show up are spending significantly more. How does that math work? Who are these big spenders?
The counterweight to the disappearing DIY consumer is the core small to medium pro customer.
Ah, the contractors.
Right, the independent contractor, the local plumber, the property manager. When a pro walks into Lowe's, they aren't buying a single can of touch-up paint.
No, they're grabbing a flatbed cart.
They are loading a flatbed cart with $2,000 worth of lumber, wiring, and plumbing fixtures for a whole room remodel.
So the pro customer's resilience is entirely responsible for inflating that average ticket size and keeping the overall revenue afloat.
100%. It's the pros holding up the entire top line.
This dynamic perfectly illustrates what CEO Marvin Ellison referred to as the K-shaped economy.
Yeah, that term gets thrown around a lot.
We hear economists throw that term around on financial news networks constantly, but looking at Lowe's earnings provides a really visceral, real-world map of how a K-shaped recovery actually functions in retail.
It really does. For those listening who might not be familiar, a K-shaped economy maps out a scenario where different socioeconomic tiers experience radically divergent financial realities.
Hence the two arms of the letter K.
Right. The upper arm of the K represents the high-income consumer. These are individuals who likely have significant equity in their homes, robust investment portfolios, and very secure employment.
So they aren't really feeling the pinch at the grocery store.
They are entirely insulated from the day-to-day pinch of grocery inflation. This upper arm is still spending aggressively on major modernization projects.
Like high-end kitchen remodels or, premium outdoor living spaces.
Exactly. Things that require a pro to install.
And the lower arm of the K.
That represents the average middle to lower income consumer. They are getting absolutely battered by cumulative inflation over the last 3 years.
Exhausted savings accounts, higher credit card interest rates.
Yeah. This is the consumer who walks into the store, looks at the price of a mid-tier riding lawnmower, and decides they can probably just fix their old push mower for one more season.
Which is why the DIY transactions are down. The earnings data maps flawlessly onto this K-shape.
Flawlessly. Management explicitly noted that high-income consumers are still engaging heavily, particularly in pro-driven categories like rough plumbing, electrical, and heavy building materials.
Meanwhile, the big-ticket discretionary items aimed at the typical DIYer, things like aesthetic upgrades and non-emergency appliance replacements, are severely lagging.
Yeah, nobody's replacing a fridge unless the compressor completely dies.
Right. But macroeconomic theory is only half the battle when you sell physical goods that are used outdoors. You are constantly at the mercy of a variable that no CEO can control.
The weather.
The weather. When we look at the chronological breakdown of Q1, the demand curve was an absolute roller coaster, heavily dictated by meteorology.
Oh, peeling back the monthly layers reveals the true volatility of the quarter. It was wild.
What happened in February?
In February, comparable sales plunged into negative territory, down 1.4%.
1.4% down. But the mechanism behind that drop wasn't a sudden shift in consumer confidence, right?
No, it was a brutal series of severe winter storms that paralyzed massive portions of the country.
Right, I remember that. Deep freezes all over the South and Midwest.
When roads are covered in ice and roofs are buried in snow, nobody is driving to a home improvement store to browse for mulch or deck sealant.
The executives highlighted a staggering statistic regarding that weather impact on the call. Just the first weekend of February alone took a 30 basis point bite out of the entire 3-month quarter's performance.
That is incredible. One bad weekend shaved 0.3% off a multi-billion-dollar quarter.
It perfectly illustrates the fragility of the seasonal retail calendar. You literally can't afford a rainy weekend.
But the dynamic inverted as the seasons changed. When the weather finally thawed, the pent-up demand just exploded.
So what did March look like?
March saw an incredible bounce back, posting a positive 2.1% comp, and then April settled at a positive 0.5%.
So the mathematical average of that frozen February and the hyperactive March and April is what generated that final 0.6% positive comp for the quarter.
Exactly. It wasn't a steady 0.6% across the board. It was a massive dip followed by a huge surge.
And that April recovery wasn't just a happy accident of sunshine either. It was heavily engineered by Lowe's execution of their SpringFest event.
Oh, SpringFest. The logistics of pulling off a retail event of that magnitude are staggering.
Right. I mean, they had to coordinate massive supply chains across live goods, like plants and soil, landscape products, and heavy outdoor power equipment from brands like John Deere and Toro.
Ensuring every single store had enough inventory exactly when the weather broke in their specific region. It's a logistical nightmare.
But they nailed it.
They had to. Spring is the undisputed Super Bowl of the home improvement industry.
A retailer's performance in these crucial weeks really dictates the trajectory of their entire fiscal year.
It does.
Yeah.
Because if you fail to capture the consumer's wallet when they are planting their garden or replacing their lawnmower in April, you cannot magically manufacture that revenue in October.
Right. Nobody is buying a lawnmower in the fall. So Lowe's managed to perfectly align their marketing, their inventory load-in, and their promotional cadence to capture that localized, weather-dependent demand.
Which saved the quarter.
It did. But here's where it gets really interesting. Selling bags of soil and pressure washers is, the legacy hardware playbook.
The old school stuff.
Right. But Lowe's is executing a parallel strategy on the digital front that feels entirely disconnected from traditional brick-and-mortar retail.
You're talking about the online sales.
Yes. They reported a massive 15.5% growth in online sales this quarter.
That kind of digital acceleration for heavy, bulky goods is unprecedented. You don't think of people ordering drywall on their phone.
No, you don't. And is being driven by an aggressive, almost Silicon Valley-esque deployment of generative artificial intelligence.
Yeah, the retail industry has been treating AI as a buzzword for the last 2 years, just throwing it in press releases.
But Lowe's is actually utilizing it as a tangible revenue-generating mechanism.
Exactly. Their MyLo AI assistant isn't the primitive decision tree chatbot from 5 years ago that could only tell you store hours or, track a package.
Press 1 for store hours. It's not that.
No, this is a highly sophisticated, generative AI-powered shopping assistant. It is actively processing over 1 million complex customer inquiries every single month.
Over 1 million a month. That's huge. I want to break down exactly how an agentic AI functions in a hardware environment. Because if a customer is building, say, a retaining wall, they aren't just buying a product.
Right, they're solving a complex engineering problem.
Exactly. So how does this AI actually interact with that customer?
Well, the mechanism operates through a framework known as Retrieval Augmented Generation, or RAG.
RAG. Okay, what does that actually mean for the user?
Basically, the AI is constantly ingesting thousands of pages of building codes, material specifications, and project tutorials.
Oh, wow. So it actually knows how to build things.
Exactly. So a customer can type into the app, I need to build a 15-foot retaining wall in a climate that freezes.
And the AI doesn't just link them to a cinder block.
No, it calculates the necessary drainage gravel, the specific structural adhesive, the exact type of block required for that height, and instantly generates an entire shoppable project list.
Tailored to their local store.
Tailored to the customer's exact local store inventory in real time.
That is wild. And the return on investment for that technology is shocking. The data shows that the conversion rate for online customers who utilize the MyLo AI tool is triple that of customers who navigate the site manually.
Triple the conversion rate.
Yeah, 3 times higher. Why does a conversational interface lead to a 3 times higher likelihood of someone actually pulling out their credit card?
Because it entirely eliminates the paradox of choice and decision fatigue.
Ah, right. Just being overwhelmed.
Think about it. Walk down the fastener aisle of a Lowe's. There are literally thousands of different screws, bolts, and anchors.
It's terrifying if you don't know what you're looking for.
Exactly. The sheer volume of choice is paralyzing for a novice DIYer, which leads to high rates of cart abandonment online. They just give up.
I'll figure this out later, and then they never buy it.
Right. But the AI acts as an expert digital contractor. It narrows the funnel instantly, giving the customer the exact right product and providing the confidence necessary to execute the transaction.
It gives them permission to buy because they know it's the right part.
Exactly. But here's the kicker. They aren't just pointing this technology at the DIYer.
Right. They're bringing it in-store. They are integrating it into the physical stores to serve the pro customer through a feature called materials lists.
Which essentially turns everyday store associates into superhuman estimators.
Break that down. How does that work at the pro desk?
The operational leverage here is brilliant. Historically, a contractor would walk up to the pro desk with a coffee-stained architectural blueprint, right?
Or like a messy, handwritten list of raw materials on a legal pad.
Exactly. And an associate would have to spend hours, sometimes days, manually hunting down SKUs, checking inventory across multiple stores, and building a quote.
That's a massive bottleneck.
Massive. So Lowe's implemented an AI system equipped with advanced optical character recognition, OCR, and large language models.
So what does the associate do now?
The associate literally just scans that messy coffee-stained document. The AI instantly cross-references the handwriting against the store's real-time inventory and pricing database and spits out a comprehensive, actionable quote in minutes.
From 3 hours to 3 minutes.
Yeah. That doesn't just save time, it fundamentally changes the capacity of the store.
If an associate goes from spending 3 hours on a quote to 3 minutes, they can process exponentially more pro volume without the company having to hire additional headcount.
It's the ultimate efficiency play. It's that PPI, perpetual productivity improvement in action.
That is fascinating. And they are pushing the boundaries of customer loyalty even further with a new program called Home Care Plus.
Oh, yeah. The subscription model.
Right. This is a subscription service aimed at routine home maintenance. Launching a subscription model in the hardware space is, well, it's a fascinating psychological experiment.
It really is, because hardware retail is inherently reactive.
A pipe bursts, a light fixture breaks, a lawnmower engine dies. The customer reacts by going to the store to solve the immediate emergency.
But Home Care Plus attempts to transition the consumer relationship from reactive to proactive.
It functions almost like a subscription box for your house. Exclusively available to MyLowe's rewards members, it deploys trained Lowe's associates to perform high-performance preventative maintenance.
Like changing out complex HVAC filters, flushing water heaters, cleaning gutters.
Yeah.
Things people hate doing.
Exactly. But let's be critical here for a second. Are average homeowners actually clamoring to subscribe to home maintenance? Or is this just a mechanism to squeeze recurring revenue out of a DIY base that is already under severe financial pressure?
It's absolutely a calculated strategy to capture lifetime value. I mean, think about the friction of homeownership.
There's a lot of friction.
Right. The average consumer lacks the time, the tools, or the specialized knowledge to properly maintain major household systems.
Most people don't even know they need to flush their water heater.
Exactly. So by offering a subscription, Lowe's is locking in that customer's loyalty long before an emergency ever occurs.
Oh, I see. So when that customer eventually needs a $2,000 refrigerator or a total kitchen remodel, who are they going to call?
The company that has been reliably maintaining their HVAC system every quarter.
That is really smart. It's early days, and management admits it's an experiment, but the goal is to dominate the entire life cycle of the home, not just the repair phase.
Yeah. Get them before things break.
So they are utilizing cutting-edge AI to triple online conversions, and they are testing subscription models to lock in recurring revenue. Those are fantastic mechanisms for squeezing out a positive quarter in Q1.
They definitely help save the day.
But loyalty programs and chatbots won't magically fix the massive macroeconomic elephant in the room that is going to plague them for the rest of the year.
You know they won't. Which brings us to the forward guidance.
Let's look at the guidance. Guidance is where management sets the narrative for Wall Street. Investors don't buy a stock for what the company did yesterday. They buy it for the cash flow it promises to generate tomorrow.
And Lowe's management planted their flag with absolute confidence on this call. They reaffirmed their full fiscal 2026 outlook.
Without flinching. They are projecting $92 to $94 billion in total sales.
Maintaining an operating margin of 11.6% to 11.8%.
And delivering a full-year adjusted EPS of $12.25 to $12.75.
If we connect this to the bigger picture, the sheer audacity of affirming that guidance becomes clear.
Audacity is the right word. They are promising to hit massive financial targets while swimming against the current of the most stubborn macroeconomic hurdle in modern real estate history.
The lock-in effect.
The lock-in effect.
Yeah.
I want to spend some time on this because you cannot understand retail hardware without understanding the golden handcuffs currently trapping the American homeowner.
The lock-in effect is the defining structural paralysis of the current housing market. Let's look at the mechanics of it.
Please.
Millions of homeowners refinanced or purchased homes between 2020 and 2022. Securing historically anomalous 30-year fixed mortgage rates hovering around 3%.
Sometimes even high twos.
Right. It was basically free money. But today, mortgage rates are aggressively higher, oscillating between 7% and 8%.
Which means a homeowner who wants to move to a slightly larger house, say they had a kid, or relocate to a different neighborhood, they are facing a catastrophic financial penalty.
Huge. If they sell their current home, they surrender that 3% rate forever.
And taking on a new mortgage at 7.5% could easily double their monthly payment for the exact same amount of principal.
Exactly. So what do?
They stay put. They turn their current homes into financial vaults.
Precisely. And we have to consider how that paralysis severs the natural artery of hardware sales.
Right, because moving drives spending.
Historically, housing turnover is the ultimate catalyst for home improvement spending. There are two massive spikes in spending that happen when a house is sold.
Okay, what's the first one?
The pre-sale preparation. This is where a seller upgrades the landscaping, paints the interior, and fixes the deck to maximize their listing value.
Gotta make it look good for the open house. And the second spike?
The post-sale customization. That's where the new buyer rips out the old carpet, remodels the master bathroom, and buys all new appliances to make the house their own.
2 huge bursts of spending per transaction.
Yep. But with housing turnover plummeting to historic lows, those twin spikes of massive discretionary spending have virtually vanished.
The natural engine of the industry is just turned off. Yet Lowe's is looking at this frozen landscape and telling Wall Street, don't worry, we are still going to grow our earnings.
That requires an incredible amount of faith in their ability to steal market share in the pro sector, because the organic tide is not rising.
Not at all. And management is fully aware that capturing that market share will require tactical sacrifices in the near term.
They definitely are, which is why they issued a very specific, carefully worded warning regarding the upcoming second quarter.
Yeah, I wanted to ask about this. They explicitly advised analysts that Q2 adjusted EPS will likely come in roughly 2% below the prior year.
They are essentially pre-announcing a slight contraction in profitability for the immediate summer months.
Wait, I'm looking at these projections and I'm genuinely confused. Spring is their Super Bowl, sure, but Q2 covers May, June, and July, the absolute peak of outdoor project weather.
It is the busiest season.
So if they just proved they can hold their margins steady in Q1 while absorbing massive acquisition costs, why on earth are they intentionally forecasting a profit dip during their busiest season?
The mechanism driving that Q2 compression is a combination of uncontrollable macro factors and highly intentional strategic pricing.
Start with the uncontrollable factors. What's hitting them?
First, they are absorbing a massive spike in transportation costs. And this is tied directly to recent volatility in global oil prices.
Fuel costs.
Right. Home improvement retail is a game of moving incredibly heavy, bulky items. Lumber, drywall, concrete, washing machines.
They don't ship easily.
No. So when diesel prices spike, the cost to move that inventory from a coastal port to a regional distribution center and finally to the local store floor just skyrockets.
Fuel is basically the invisible tax on the entire retail supply chain.
Perfectly said. And because they're committed to their PPI initiatives, protecting the consumer from price shocks, they are absorbing a significant portion of that transportation tax internally.
Which inherently compresses the margin.
Exactly. They are eating the cost so the customer doesn't have to.
Okay, what's the second factor?
The second factor is the ongoing integration of those FBM and ADG acquisitions we talked about. Bringing an entirely distinct corporate infrastructure online requires heavy upfront capital expenditure.
Right, before the long-term synergies are actually realized.
Yeah, it takes time. But the third, and arguably most important driver of the Q2 profit dip, is their aggressive promotional strategy.
Meaning discounts.
Yes. They are intentionally sacrificing margin to buy market share.
They are slashing prices for the big summer holidays, Memorial Day, Father's Day, the 4th of July.
We have to view this through the lens of consumer psychology. Remember that K-shaped economy we discussed?
Where the lower arm is getting squeezed.
Exactly. That lower to middle income consumer is highly sensitive to value right now. If Lowe's holds their prices firm just to protect their margin, that consumer might simply defer the purchase entirely.
Or they migrate to a discount competitor.
Right. By heavily promoting appliances, outdoor power equipment, and patio furniture during these key holiday weekends, Lowe's is ensuring they maintain their dominant market position.
Even if they make a few dollars less on each specific transaction.
It's about keeping the customer in the ecosystem.
So what does this all mean for the roadmap of the rest of the year? Management is proposing a calculated bargain to Wall Street, basically.
They are saying, stomach a slightly bumpy, less profitable Q2.
Trust that we are using promotional discounts to win the summer traffic and absorb the shipping costs.
And by the time we hit the back half of the year, our internal productivity initiatives and our expanding pro business will accelerate our momentum to comfortably hit our full year targets.
It is a textbook example of managing short-term expectations to protect a long-term strategic vision.
It really is. Set the bar slightly lower for the summer so you can leap over it in the fall.
Which brings us to the ultimate question for the retail investor listening to this breakdown. When we synthesize all of this raw data, the consumer headwinds, the AI acceleration, and the Q2 margin warnings.
What is the definitive takeaway?
Right. Are we looking at a bullish or a bearish signal for Lowe's over the long horizon?
Well, what's your take?
My take, when you look past the immediate noise of that tiny 0.6% comp and the temporary Q2 fuel tax, the underlying architecture of this business is fundamentally bullish for the long-term investor.
I completely agree. And the core rationale behind that bullish stance relies on one specific mind-blowing demographic reality that the CEO casually dropped into the earnings call.
Oh, the housing deficit number.
Yes. He noted that to simply meet the baseline demographic demand, the United States will need to construct roughly 12 million new homes by the year 2033.
12 million new homes. That is a staggering figure.
The demographic pressure cooker driving that 12 million home deficit is the single most important macroeconomic trend of the next decade.
How did we get here, though? How are we short 12 million houses?
If we rewind to the 2008 financial crisis, the entire home building industry was basically decimated. For a decade, new construction fell dramatically below historical averages.
Builders just stopped building.
Right. Meanwhile, the millennial generation, the largest demographic cohort in American history, aged directly into their prime home buying years.
Creating this massive demand colliding with non-existent supply.
Exactly. Furthermore, strict local zoning laws and a chronic shortage of skilled tradespeople have artificially suppressed new construction even as demand soared.
So we have a structural deficit of 12 million homes that have to be built over the next decade. But historically, Lowe's has generated zero revenue from the new home construction market.
None. They were entirely boxed into the repair and remodel sector.
Right. If a massive commercial home builder was putting up a 500-home subdivision, Lowe's wasn't seeing a dime of that initial construction spend.
But their recent acquisitions fundamentally alter their DNA.
This is the genius behind acquiring foundation building materials, FBM, and the appliance delivery group.
By integrating FBM, Lowe's has instantly built an interior solutions platform for large-scale residential and commercial builders.
They aren't just selling a few sheets of drywall to a local handyman anymore.
No, they have the wholesale distribution network to supply the metal framing, the industrial insulation, and the acoustic ceilings for massive multifamily apartment complexes and huge commercial subdivisions.
They're positioning themselves to capture a massive slice of a $250 billion total addressable market that they previously did not even participate in.
It's brilliant. When interest rates eventually normalize, and they will, and builders are unleashed to construct those 12 million missing homes, Lowe's is now structurally integrated into the very foundation of the commercial building supply chain.
They are massively expanding their total addressable market at the exact moment when the real estate market is at its absolute bottom.
Buy-low, literally. And they are simultaneously engineering a solution to the labor shortage that threatens to throttle that future growth.
Right, because you can't build 12 million homes without workers.
Management highlighted a $250 million investment by the Lowe's Foundation aimed specifically at training and developing the next generation of skilled tradespeople.
$250 million. Their stated goal is to support and certify 250,000 individuals in the trades over the coming years.
Now, you have to ask yourself, why would a retail hardware store spend $250 million funding trade schools and community college plumbing programs?
Because it is a brilliant closed-loop ecosystem play.
Exactly. Their pro customers, the contractors who drive their high-margin volume, are constantly constrained by a lack of skilled labor.
Right. A contractor can't take on 5 new kitchen remodels if they can't hire enough licensed electricians or carpenters.
By actively funding the education of 250,000 new tradespeople, Lowe's is literally manufacturing its own future customer base.
It's wild to think about. When those newly minted plumbers and electricians graduate and start their own businesses, who are they going to buy their tools and materials from?
The company that funded their education, Lowe's.
So let's distill all of this complex macro theory into actionable insight for you, the investor listening to this. We are not giving financial advice, obviously, but we want you to understand the implications of holding this stock.
Right. If you currently hold shares of Lowe's, the data suggests that patience is your greatest asset.
Do not get spooked by the minor Q2 earnings warning. The company is generating a fantastic return on invested capital, sitting at 26.8%.
They are utilizing their cash incredibly efficiently. And while you wait for the housing market to unfreeze, you're collecting a $1.20 per share quarterly dividend.
They paid out $674 million in dividends this quarter alone, just to reward shareholders for their patience.
Conversely, if you are analyzing this stock from the outside and considering initiating a position, you need to view Lowe's as a strategic, long-horizon play on the inevitable thawing of the American housing market.
You are looking at a best-in-class operator that has proven it can grow its earnings and capture market share in an incredibly hostile environment.
Prepare yourself for short-term volatility in the upcoming second quarter, as those transportation costs and holiday promotions compress the margins slightly.
But if you fundamentally believe in the demographic reality of the 12 million home deficit, those short-term dips reflect a company winding a tightly coiled spring.
If they're figuring out how to win when the macroeconomic scoreboard is completely broken, imagine the sheer velocity of their growth when the rules of the game return to normal.
This raises an important question, and it's an implication that stretches far beyond the scope of a traditional retail earnings report.
Lay it on me.
We've mapped out how Lowe is acquiring massive commercial distribution networks through FBM, integrating sophisticated agentic AI to manage complex supply chains, and single-handedly funding the education of 250,000 new tradespeople to bypass the national labor shortage.
Right.
If they execute this vision flawlessly, are we witnessing the twilight of the traditional DIY hardware store and the birth of a fully integrated, privatized national infrastructure company that dictates how America builds its future?
That is the scale of the strategic pivot happening right in front of us. They are transforming from a place where you buy a hammer into the underlying circulatory system of American construction.
Wow. Thank you for joining us on this incredibly deep talk tickers exploration. Dive into the data, keep questioning the consensus, and we will catch you on the next one.